Have you ever pondered where the rich invest their money? It's an intriguing question, isn't it? It's not just about having money, but knowing how to make that money work for you. That's the realm of wealth management, a world where smart investment strategies are the keys to the kingdom. Now, the rich don't just stuff their cash under the mattress. They're playing a different game from the average person. For them, investment isn't just about preservation of wealth. It's about growth, expansion, and strategic risk-taking. They're investing in a diverse array of assets, from real estate and stocks to startups and even art. They understand the power of compounding, the importance of diversification, and the art of making informed decisions based on solid research, not just gut feelings. So are you curious to know more? Stay tuned as we unravel the mystery of the rich's investment strategies. Let's dive into the investment strategy of one of the wealthiest individuals in the world, Warren Buffett. Often referred to as the Oracle of Omaha, Buffett's wealth didn't materialize overnight. Instead, it's the result of consistent value-oriented investing. This strategy is centered on the belief that the stock market can undervalue companies. Buffett seeks out these undervalued companies, taking a long-term position and waiting for the market to recognize and correct the company's true value. Consider, for example, Buffett's investment in Coca-Cola. In the late 80s, the soft drink giant was undervalued, but Buffett saw the intrinsic value in its brand and worldwide reach. He invested heavily, and today his stake in Coca-Cola is worth billions of dollars. Then there's the case of Apple. While Buffett is known for avoiding technology companies, he made an exception for Apple. Recognizing its strong brand and loyal customer base, he saw the company as undervalued. The result? A lucrative investment that has since yielded significant returns. Buffett's success is not about jumping on the latest trend or trying to time the market. It's about patience, careful analysis, and conviction. It's about understanding the difference between a company's price and its value. His approach may not be flashy, but it's undeniably effective. After all, his net worth of over $80 billion speaks volumes. Buffett's strategy is a testament to the power of patient, long-term investing. Another titan in the investment world is Ray Dalio. This savvy investor, known for his wisdom and knack for predicting market trends, has a unique approach to investing. It's called the all-weather strategy, and it's as intriguing as it sounds. The all-weather strategy is all about diversification. Dalio doesn't put all his eggs in one basket. Instead, he spreads his investments across a wide range of assets and industries. This way, he can withstand the ups and downs of the market. Even when one sector is underperforming, he has others to fall back on. But what makes Dalio's strategy so effective isn't just diversification, it's also his keen eye for risk management. He doesn't shy away from risky investments, but he also doesn't dive in without a safety net. He carefully weighs the potential rewards against the risks, ensuring that he's well prepared for any outcome. A shining example of Dalio's strategy in action is Bridgewater Associates. This is one of the most successful hedge funds in the world, and Dalio's all-weather strategy is at the heart of its success. Bridgewater has weathered countless market storms, always coming out on top thanks to Dalio's strategic diversification and risk management. Dalio's approach underscores the importance of diversification and risk management. It's a reminder that smart investing isn't about chasing the next big thing. It's about having a well-thought-out strategy and sticking to it, no matter what the market throws your way. Let's look at a more aggressive investment strategy by Carl Icahn. This titan of the investment world is renowned for his activist approach. Icahn doesn't just invest in companies, he takes substantial positions and pushes for management changes. His strategy is bold, assertive, and not for the faint of heart, but the results speak for themselves. Take Herbalife, for instance. Icahn saw an opportunity in a company mired in controversy. He bought a significant stake and defended the company against naysayers, ultimately making a considerable profit. Then there's Dell, a tech giant struggling to keep up with the times. Icahn stepped in, pushed for changes, and the company has since seen a resurgence. But it's important to remember that Icon's approach is not without risk. His aggressive strategy can lead to high rewards, but also high stakes. It's a balancing act of power, persuasion, and sheer business acumen. Icon's strategy showcases the potential rewards and risks of active investment. Now that we've examined these investment strategies, what can we learn from them? Each of these financial titans, Warren Buffett, Ray Dalio, and Carl Icahn, have their unique approaches, but common themes emerge that we can all take to heart. Let's start with Warren Buffett. The Oracle of Omaha's strategy is a masterclass in patience and long-term thinking. Buffett's preference for value investing and holding on to his investments for an extended period shows us the power of patience. It's not about making quick money, it's about making wise decisions and waiting for them to bear fruit. Ray Dalio, the hedge fund king, imparts the importance of diversification. His all-weather portfolio is a testament to this, spreading investments across different asset classes to mitigate risk. Dalio's approach teaches us not to put all our eggs in one basket. Instead, we should distribute our investments judiciously to minimize potential losses. Next, we have Carl Icahn, the activist investor. Icahn's strategy emphasizes the importance of active management. He doesn't just buy shares, he gets involved, influencing company decisions to increase shareholder value. This approach underscores the importance of not being a passive investor. We must understand our investments and, when necessary, take an active role in their success. In summary, these strategies offer valuable lessons. Patience, as exemplified by Buffett, is key to reaping long-term benefits. Diversification, as Dalio shows us, is crucial in hedging against risks, and active management, Icahn's forte, can be a game-changer in maximizing returns. But most importantly, remember that these strategies are not overnight success formulas. They require dedication, research, and a deep understanding of the market. As we move forward in our investment journey, let's take these lessons to heart, adapt them to our unique circumstances, and strive to make informed and prudent decisions. Remember, the rich didn't get rich by accident. They invest wisely and patiently. Perhaps now you can too.